In 2008, the global financial system nearly collapsed. Not a small dip, not a normal recession. The entire machine almost stopped. Banks froze, stock markets crashed, trillions of dollars vanished. And the strange part? Most of it started with ordinary people buying houses. Imagine this. A bank hands someone a mortgage for a house they probably cannot afford. That sounds risky, but the bank doesn't care because the bank isn't planning to keep that loan. Instead, the bank sells the loan, and that single decision quietly changed the entire financial system. For decades, the system was simple. A bank gives you a mortgage, you pay it back over 30 years. The bank earns interest. Everyone understands the risk. If you stop paying, the bank loses money. So banks were careful. They checked income, credit history, and employment. But in the early 2000s, something changed. Banks discovered a way to remove the risk, at least on paper. Here's how the new system worked. Instead of holding mortgages, banks bundled thousands of them together. Imagine taking 1,000 home loans, mixing them into one giant financial package, and then selling pieces of it to investors around the world. These bundles were called mortgage-backed securities. Suddenly, mortgages were no longer boring bank loans. They became global financial products. Pension funds bought them, insurance companies bought them, and investment banks traded them, and everyone loved them because they seemed safe. After all, houses rarely fall in price, at least that is what people believed. But once banks realized they could sell the loans, something dangerous happened. Standards disappeared. Why carefully check borrowers if the risk will belong to someone else? So banks began approving mortgages for almost anyone. Low-income borrowers, no-income borrowers, and people with terrible credit. These became known as subprime mortgages, and the numbers exploded. Between 2000 and 2007, subprime lending skyrocketed. Millions of Americans were buying homes they realistically could not afford. But for a while, it worked, because housing prices kept rising. And when housing prices rise, everyone looks like a genius. Homeowners feel richer, banks make more loans, investors earn steady returns, politicians celebrate homeownership. The system looks healthy, but underneath, the math is quietly breaking. Here's the hidden mechanism most people did not see. Those mortgage bundles were sliced into layers. The top layer looked extremely safe. Rating agencies even stamped many of them with AAA ratings, the same rating given to U.S. government debt. But the safety was an illusion, because all those loans depended on one fragile assumption: housing prices would never fall everywhere at the same time. That assumption turned out to be wrong. Around 2006, housing prices stopped rising. Then they started falling, slowly at first, then faster. And when prices fall, a strange incentive appears. Imagine you bought a house for $400,000, but now it's worth $250,000. Your mortgage is larger than the house itself. Some people simply walked away. Defaults started climbing. Once homeowners stopped paying mortgages, the financial products built on those mortgages began collapsing. Those safe mortgage bundles were suddenly full of bad loans. Investors couldn't figure out what they actually were worth. Banks didn't trust each other, and trust is the invisible fuel of the financial system. Without it, everything freezes. By 2008, panic had spread across Wall Street. One of the largest investment banks in the world, Lehman Brothers, collapsed almost overnight. 158 years of history gone in days. Markets spiraled, credit disappeared, businesses couldn't borrow money. Even healthy companies suddenly faced bankruptcy because the financial plumbing had clogged. Governments were forced into an uncomfortable choice: let the system collapse or rescue the institutions that caused the disaster. The United States stepped in with massive bailouts. The program was called the Troubled Asset Relief Program. Hundreds of billions of dollars were used to stabilize banks. Central banks around the world flooded markets with liquidity. Emergency interest rate cuts and unprecedented stimulus followed. It worked eventually, but the damage was enormous. Global stock markets lost trillions of dollars, millions of people lost their jobs, homes were foreclosed across entire neighborhoods. Families who had nothing to do with Wall Street paid the price. Meanwhile, some of the institutions at the center of the crisis survived, a strange outcome. Risk was private during the boom and public during the crash, and the irony is hard to ignore. The financial system was supposed to spread risk. Instead, it concentrated it in ways almost nobody understood. Complex models replaced common sense. Credit ratings replaced skepticism. Short-term profit replaced long-term stability. And for years, the system kept expanding until the math finally caught up. Today, the world lives in the shadow of that crisis. Banks face stricter regulations, capital requirements are higher, stress tests are routine, but the basic incentives inside finance have not disappeared. Money still searches for yield, risk still hides behind complexity, and every generation believes this time the system is safer, which raises an uncomfortable question. If a crisis this large could grow quietly inside the global financial system once before, what might be building inside it right now that we still do not fully understand?